Okay, in this video we're going to go through starting to read business transactions and recording them. You'll see down here I have some columns laid out. We have some assets, right? These are things that the company owns. We have cash, accounts receivable, office supplies, office equipment, and building. Okay? Then we have some liabilities, things that the company owes, accounts payable, notes payable. And then we have equity. This is common stock. When an owner puts assets into the business, they get common stock in return. And retained earnings. This is the earnings that is retained in the business. So that's going to be made up of revenue less expenses. Okay, so any revenue that we earned is going to go in this column as a positive, and then the expenses that the company pays will be entered in this column as a negative. And make sure you read all the little hints that I put in. It says if an account decreases the balance of the account, make sure you enter it as a negative amount or it will be marked incorrect. Okay? So the first thing we have to do is read the transaction. A stockholder invests $45,000 cash and a building with a fair market value of $120,000 to the company in exchange for stock. So one of the owners is investing in the company, and it tells you cash of $45,000, so that's going to increase the company's cash balance by $45,000. So we put that in there. And a building with a fair market value of $120,000. So the company is now going to own that building. Oops, one too many zeros. The company is now going to own that building, so that's going to increase the building assets. And in return for these two assets, the owner is going to get common stock in the company. That is a certificate showing that he owns, let's see, 120 plus 45 would be $165,000. So he's going to get $165,000 worth of stock. Remember, whenever you record a transaction, whatever you do on one side of the accounting equation, assets, has to also be done to the other side of the accounting equation, liabilities and equity. So if I got $165,000 of assets going up, something over here has to go up by that amount, either liabilities or equity. Okay, for every single business transaction. Part B, we borrowed $20,000 cash from the bank by signing a promissory note that will be paid back over the next 3 years. So if we borrow money from the bank, they're going to give us a check. We're going to put it in our checking account, so our cash is going to go up by $20,000. We did something to the assets, so we have to do something over here. And it says we signed a note. So whenever it says a note, that's going to be notes payable, not accounts payable. So our notes payable, our liabilities, are going to go up by $20,000 as well. So whatever you do to one side, you have to do to the other. Remember, the accounting equation's assets equals liabilities plus equity. So in order to hold that in balance, right, the scale's got to be in balance. Whatever you do to one side, you have to do to the other. All right? The next one, we purchased office supplies worth $1,500 of cash. So we paid cash out this time. We purchased supplies. So our cash is going to go down. So remember, we have to enter that as a negative amount. And it says we purchased office supplies. So our office supplies are going to go up. Whenever we use the office supplies, that will be a negative there. But we purchased them right now, so we're putting them in. Our assets for office supplies going up. So you'll see on this particular transaction, we didn't have to do anything to this side of the accounting equation because we had one asset going up and one asset going down. Okay, so that's going to balance each other out. So it's basically a negative overall to the asset. I mean, a zero wash to the assets. So we didn't have to do anything on this side of the accounting equation because it's just one asset went up and one asset went down. All right, part D. We purchased a computer from Office Max on account. So this time we didn't pay cash. We didn't sign a note. We're buying it on account. So that's going to be accounts payable. So when you're reading the transactions, these are the things that have to go through your head, right? So that's going to be office equipment because it's a computer. So we didn't pay cash, right? So it's not going to be cash. But our office equipment is going to go up by, what was it, $1,250, because that's a piece of equipment that we're buying for the company. And we bought it on account. So that's going to be accounts payable. At some point in the next 30 to 45 days, we're going to have to pay that account off. So if it says we purchased something on account, that's always going to be accounts payable. If it says you signed a note, that's going to be notes payable. So we did something to one side of the accounting equation. We had to do something to the other to balance it out. E says we provided consulting services of $3,200 to a client on account. So this time, we provided services, and whenever we provide services, whether the customer pays us at that time or not, we have to record the revenue. And remember, I said revenue was going to be recorded in this retained earnings. Revenue is going to be recorded as a positive, and expenses will be recorded as a negative. So since we've already provided the service, we have to increase our revenue or retained earnings by the amount of service we provided. And it doesn't say the customer paid us. It says we did it on account. So that's going to be accounts receivable. That customer is going to owe us that money sometime in the next 30 days, 30 to 45 days, depending on what our terms are with this customer. Okay, so if it says we provided a service on account, that's always going to be your revenue increasing and accounts receivable increasing. You increase an asset and you increase your revenue. So this F says we paid $1,700 of rent for the month. So whenever it says you paid an expense for that month, it's always going to be an expense. If it says we paid $1,700 for rent for the next 3 months, that would be prepaid rent. We're going to pay the rent for the next 3 months, so we're prepaying. But if we're paying in that particular month, it's going to be rent expense. And it also says we paid, so that's cash going out of our checking account, right? It's not on account. We're actually paying it. So that's $1,700 minus to our cash. And it's an expense for this month. So that's our expenses are going to be recorded in retained earnings as a negative amount. So our assets are going down and our equity is going down. Remember that accounting equation has to stay in balance. Placed an advertisement in the local paper that will run during the current month, and we paid cash. So again, we know we paid cash, so our cash is going to go down by $260, and it's an expense of the current month, so it's like an advertising expense. So an expense for the current month has to reduce our retained earnings. So our assets went down and our retained earnings went down. Okay. H is we paid our Office Max account in full for the computer that we purchased up in D. So remember, up in D, we purchased a computer and we bought it on account. So now we're paying that accounts payable off in H. So it says we paid. So anytime it says we paid, you know your cash is going down. And our liabilities are going down because now we've paid this off. So again, assets go down, liabilities go down. That holds that accounting equation in balance. The customer billed in transaction E has now paid on their account. So in transaction E, we provided a service of $3,200. They're not paying the full amount. They're only paying $800 of it. So if a customer pays us, right, that's cash coming into the business. So that's going to increase our cash. And it was an accounts receivable. So that asset is going to go down. They no longer owe us the whole $3,200, right? They're going to owe us the $3,200 minus $800, whatever that happens to be. Okay, so that's one asset going up, one asset going down. So that's a net zero effect to assets, so nothing on this side has to be affected. We provided consulting services for $450 cash. So we provided a service. Anytime you provide a service, whether the customer pays you at that point or not, it's going to be revenue. So we know that our revenue is going to be going up. Let me make sure I'm on the right line here. Our revenue is going to be going up, and remember at the very beginning I said anytime we have revenue, it's going to be an increase to our retained earnings. And it says they actually paid it. We didn't bill them for it, so our cash is going to be going up. The customer paid us, they gave us a check, we deposited it into our checking account. We declared and paid a cash dividend of $300, right? So if we paid something, we know our cash is going to go down. Oops, my 3 is sticking on my computer. And dividends are also paid out of retained earnings because it's not an earning that we retained in the business. This is something that the owner is taking out of the business, right? So it's not being retained, if you will, into the business. So he's taking some of those profits that he's earned. So that's also going to reduce retained earning. Expenses and dividends reduce retained earnings. And then in L, it says at the end of the month, supplies were counted, and it was determined that $840 worth of supplies purchased in transaction C. Remember, we purchased $1,500 worth of supplies. At the end of the month, supplies were counted, and it was determined $850 worth of supplies purchased in transaction C remained. So we have, of this $1,500 of all office supplies, we counted at the end of the month, and I'm going to bring my calculator up here. We counted at the end of the month, and now we only have $840 worth left. So now we have to figure out how much of those office supplies did we use, right? We had $1,500 to start with, and now we only have $840 left. So if we subtract the $840 from the $1,500, we get $660 worth of supplies that were used. So we need to reduce our office supplies by that $660 so that when we total this column up, it comes up to the $840. If you take the $1,500 minus the $660, right, that would be $840. So we know that, so we can go ahead and put that there. And what is that? That's an expense. That's an expense to the business. When we use part of our assets, that becomes an expense. Excuse me, my mouth was getting dry. So that's going to reduce our retained earnings as well. So we reduced retained earnings because we had an expense, and we reduced assets. Whatever we do to one side of the equation, we have to do to the other side of the equation so that the accounting equation stays in balance. Okay, so now all of the transactions have been recorded. So the next step in this problem would be to just add and subtract all the numbers and come up with your ending balances in all the accounts. So for cash, we have $45,000 plus the $20,000 minus the $1,500 minus $1,700 minus $260 minus $1,250 plus $800 plus $450 minus $300. Let's see if I did my math right. $61,240. Yep. Okay, let's calculate how much accounts receivable we have left. That customer that owes us $3,200, they paid $800 on their account. They still owe us $2,400. We already calculated our office supplies, and we did a count, and we said we had $840 left, so that's what that should equal out. Office equipment, we didn't sell anything off. We only bought that one computer. Building, again, that was donated by the owner. Our accounts payable, we paid that account in full, right? We purchased that computer on account, and then we paid for it. So that balance is going to be zero. We still owe on that note. We borrowed $20,000. The owner still has $165,000 of common stock, and then we have to figure out how much retained earnings we have. How much revenue did we earn, less the expenses that we paid out, less the dividend that we paid out to the owner. $1,700 minus $260 minus plus $450 minus $300 minus $660. So we have a $730 left in that we've retained into the business, right? Retained earnings means what revenue did we have minus what expenses we had minus whatever we paid out to the owner in the form of dividends. That's how much profit that we had that we're retaining in the business and didn't pay out to the owner, $730. Okay, so then the next thing we have to do is we have to prove that this accounting equation is still in balance. If the accounting equation is not in balance, if assets doesn't equal your total liabilities plus your total equity, then you've done something wrong in your transactions up there, and you have to go up back and figure out what you did wrong. Either you added one of the columns wrong, or you didn't do one of the transactions correctly. So let's add up all of our assets. We have $61,240 plus $2,400 plus $840 plus $1,250 plus $120,000. So our total assets $185,730. Our total liabilities is the 0 plus the 20,000, so that's pretty easy. And our total equity is your common stock plus your retained earnings, $165,730. And then we have to add our total liabilities and our total equity together, and it should equal your total assets. So I can do that in my head, but just to show you guys, 20,000 plus 165,730 is 185,730. And when you enter these into your spreadsheet for your homework, again, yours will turn green if it's right, and it'll turn red if they're wrong, okay? So hopefully that helps clear that problem up. I know sometimes students will see this big conglomeration down here, and it kind of freaks them out a little bit, okay? And just remember, retained earnings, if you have revenue, if you provided a service or you sold a good to a customer, that's going to increase your retained earnings. If you paid for an expense or you used up one of your assets, That's going to decrease retained earnings because that's an expense of the business. And if you paid out a dividend to the owners, that's also going to reduce retained earnings. Okay, because retained earnings is the amount of revenue less expenses less the amount you paid out to the owners. It's the amount of profit you're retaining into the business, if that makes sense. Okay? All right, I hope this helped.